is Marlena Smith, and it is my honor to co-host this call tonight. Again, have your pen and paper ready because we are going to share some very valuable information with you guys. And also, while you're listening to this presentation, if somebody comes to mind that you think can benefit from this information, please let the person that invited you know that we do this call every week. So you can invite them next week, or they can set up a one-on-one session with the person that invited you. Again, my name is Marlena Smith. This $1 million baby plan is something that I really love sharing about and I hold really near and dear to my heart. I am a mother of three amazing children. I have a 17-year-old daughter, a 12-year-old son, and a 6-year-old daughter who keep me busy all day, every day. But I am so happy that I have this plan in place for them because it gives me peace of mind that if God forbid something happens to me, they're taken care of. I'm planning for their future, and they won't have to rely on, a job they hate in the future because the benefits are good or whatever it may be, right? So we do call this call the $1 million baby call, but this plan is not only for children. Okay, so it's not only for children, but we do want to share with you a concept today that is very simple. It's about starting early and using the right tools, right? So even though this is available to all of us, I'm going to be co-hosting tonight with Miss Gabriela Encinas, and we are also $1 million babies. Okay, you don't have to be little to be $1 million baby here, but the earlier you start, the more benefits you get from this plan. So again, I'm super excited. We love sharing this information. If you do not have a pen and paper out yet, please get your pen and pad out so that you can take some notes. And um, yeah, we are super excited to share this information with you. So I want to welcome everybody on tonight. Welcome, Miss Monica, Amanda, Tammy, Lay. Thank you always for opening our call. But I'm going to pass this call on to Miss Gabriela Encinas, and I will circle back around a little bit later to share some more information with you guys.
Thank you. Thank you so much. Um, will you be sharing or?
I will share right now. Thank you.
Okay, perfect. Well, while she gets the string going there, I too am a mother. I have a beautiful daughter that's going to be 15 in a couple of months, and I have a 13-year-old son. And this presentation is also very near and dear to me because I want to make sure that my children thrive, that they succeed, that they are okay, that they're whole in the future. And so, like Marlena asked, make sure you have your notepad and take notes. And let's get started. Well, here at OIC, our mission is to empower people through financial education and entrepreneurship, mentorship. So before we actually start dive into what the $1 million baby plan is, we really need to look at the current financial realities because they truly paint a picture of why this is an important plan strategy to put into place for your children. But 60 to 70% of Americans live paycheck to paycheck. This 60 to 70% even includes those that are doing well for themselves. The reason why many Americans are living paycheck to paycheck is because life is truly expensive. So it's something to really consider. Okay, we really need to have a plan for our money. 47% of Americans cannot afford a $1,000 emergency without borrowing. That means if you have a flat tire or two, or the air conditioning breaks down, you're calling somebody to help you out, or you are swiping that credit card to get you, to assist you. Now, the average American household has a debt of $104,000. That when I read that statistic, that was just astounding to me. $104,000, but it is a reality. The average college graduate owes more than $37,853 in federal student loans. So here are some young professionals barely getting started. They can't even enjoy their paycheck because they have such debt that they're starting off with. And this is why many can't, they don't see family and success in the future at the start. It's very stressful for them. Now, the next statistic here that I read is that the average monthly Social Security benefit for 2025 was $1,976 per month. Per month. Here in California, I don't know what you can possibly do with that amount of money. Rent alone in certain places is 2,000. So these are statistics that we really need to keep in mind. Now somebody that's building a supplemental, it says here that the average 403B or 401k is about $240,000 by age 60. So if you convert this 240,000 into income for yourself using the 4% rule, you're really just adding an additional $10,000 per year. That it's just I just don't see how people can be okay. The average person will change careers every 4 years, even less amongst those age 35 and younger. That one right there is really key because what happens is when a young adult starts a career and they have the opportunity to use, the 401k retirement option through work, through their employer, they probably aren't seeing their employment as long term, so they don't invest. Or two, if they did invest, whatever little bit that they invested, they take it with them because they don't really have a plan for it. So tonight we're going to focus on giving our children a financial head start. We're going to discuss how to guide them into adulthood with the right habits and strategies for a strong financial future. We're going to go ahead on the next screen. We're going to go ahead and watch a 2-minute video that summarizes what the $1 million baby plan is all about, okay? And then we'll go ahead and take a deeper dive and go over the benefits, how it works, and how you can actually start a $1 million baby plan for your child.
A pretty money-savvy guy once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." So you're ready to start saving for your kids' future. You already understand the power of compound interest over time, so you know the sooner you start, the better. So where should you be saving that money? Let's talk about perhaps the most powerful and least known savings vehicle for kids on the market, Index Universal Life, or IUL. IUL stands out against all other savings vehicles in one main area of strength: flexibility. Other financial vehicles lock you into what you can use your savings on, but an IUL can be a first car, a college education, a down payment on a house, a wedding. IUL cash value can be used however, whenever, and on whatever you choose. Plus, since it's built on a financial chassis of life insurance, your child is instantly covered with hundreds of thousands of dollars of permanent life insurance with living benefits, simply as a side benefit of utilizing IUL as your choice of savings vehicle. Now don't freak out, the fact that it's life insurance is actually a good thing. Life insurance cash value comes with a ton of unique side benefits, like your cash value being protected from market losses, cash value growing tax deferred and being accessible tax-free, protection from lawsuits, and IUL cash value is not considered in asset calculations when applying for student loans for college. So, what could one of these policies look like for your kiddo? Let's say you had a baby today, and to take maximum advantage of the power of compound interest over time, you immediately start socking away $100 per month into an IUL. Right away, your child is now covered with $371,000 of permanent life insurance coverage with living benefits. That's a pretty nice little side benefit. And that financial foundation you establish for them today will continue to grow with them over the years and be available throughout their lifetime for whatever they need or want to use it for. Plus, if they don't access that money, right around retirement, their IUL is conservatively projected to hit $1 million of cash value. And at age 65, they could turn on a tax-free income stream of $75,000 per year that will last them the rest of their lives, no matter how long they live. The point is, they have options. IUL is the most flexible savings vehicle for children on the market, and the best time to plant that seed is today.
I really love that video. But that essentially sums up what the $1 million baby plan is. It uses an index universal life insurance policy, which is a financial strategy designed to build generational wealth. It involves purchasing an IUL policy for a child at a young age and funding it over time to accumulate cash value. Our goal ultimately is to help our children create lifelong financial benefits that include tax advantage growth, a death benefit, and the ability to borrow against the policy for major life expenses like we saw in the video. So the top 3 benefits of the $1 Million Baby Plan includes, number 1, the cash value growth. A parent, grandparent, or legal guardian can open up an IUL policy for the child. Premiums are paid into this policy, which grows in cash value based on an index interest strategy. An example, one of the index strategies that you can mirror or work with is the S&P 500 performance, and it'll have a cap and a floor. So I want to explain a little bit more about the index, but first we need to look at our options for how money grows. Okay, there are 3 options where you can generate wealth. There's fixed. Okay, the fixed strategy. This one will be for people with like really low risk level. Okay, it's got the lowest risk. Your money won't go down due to market losses. You have a guaranteed, but the potential for growth is very minimal. Okay, but you do have a guarantee. Okay, the variable. Let's see. The variable here, this one is tied directly to the performance of the market. Your money is directly invested, okay? So your earnings will be based on the performance of the stock market. The risk level here will be higher, okay? Because your values are going up and down, up and down. So the upside potential will be that you get higher growth if the market performs well, but the downside is that you can lose when the market drops. Now, think of this product like a 401k or 403b, okay? Now, the index is going to it's going to offer you a balance between growth, potential, and protection. So this is like the best of both worlds. Earnings mirror the market index, okay? Like I said earlier, like the S&P 500, but you don't actually invest in the market. So the risk level here is going to be a moderate risk. You will have a cap and you will have a floor. So you'll get some of the market upside, but no downside loss. These types of products will be like the cash value life insurance, okay? Think of it as this product being a safety net that lets you ride the market waves, but with a life jacket. So that's one of the very first benefits, very powerful benefit. The next benefit, if we can go to the next slide, thank you. Why insurance is important because when the cash value is tied into a life insurance contract, there are tax advantages. The cash value grows tax deferred, meaning you don't pay taxes on the growth as it occurs. Your child can later access this cash value tax-free through policy loans for education, home purchases, retirements, even for weddings. Home improvements later on down the line when they own a home. And the third benefit of this policy will be the wealth transfer and legacy. Through an index universal life policy, we're not just talking about protecting life, we're really talking about creating a legacy that can last for generations. So this is one of the things that I wanted to bring peace of mind to my children, but then I was also thinking about my grandchildren and my great-grandchildren. You know, someday we'll benefit from this legacy that we're creating, we're building for our children. Because as your child grows older, they can continue funding the policy and it allows it to keep building cash value over time. And with consistent growth, this policy can become a potential $1 million asset by the time they reach adulthood and are ready to retire. And that's where it really gets powerful because when the insured passes away, the beneficiaries receive a tax-free death benefit. You know, we want each of our generations to be better than the next. And this is just such a powerful tool because I can imagine, I don't know if I'm pretty sure you can imagine that eventually when this policy grows to, let's say, a worth of $2 million, that $2 million would go to the next generation completely tax-free, changing the trajectory of their life. Just really think about that impact. This is true legacy building. This is what it looks like. It's not just about the money. It's about you're giving your children, your grandchildren, the freedom to dream bigger and live better and continue passing that legacy forward. So yeah, that's what I have to share. I think the next slide, yeah, the next slide, Marlena. Yes, this is where I'm gonna hand it over to my associate business partner, Marlena, who will do a comparison for you because some of you may already have something in place for your children, but she's gonna highlight the positives of the $1 million baby in comparison to the others. Thank you.
Awesome. Thank you so much, Gabriella. And I see who's on our call here. So if you guys want to be interactive, I know this is a little off our usual, but you guys have questions, you want to talk about this a little more, let us know, right? But I will continue here. Right. When I was looking for something for my children, when I had my son, I was looking at all kinds of things, right? Like, is it a CD, a high yield savings, a 529 plan. $1 million baby was introduced to me shortly after. Oh, I'm so sorry. Gabriella, can you take over for just a moment? I'm sorry.
So yeah, right here we were comparing here a high yield savings account. A lot of times people aren't familiar with the $1 million baby plan, the IUL. But when we compare these side to side, you're going to see that each one of these will have growth potential. Okay? They all will have safety and protection. Now, when we look at a high yield savings account, it does not have a tax advantage like the 529 or the IUL will. Okay? On the high yield savings account, you are paying tax up front and tax on all your earnings. As far as liquidity goes, having access to these accounts, you will have access and some liquidity to monies that you have invested within a high yield savings account, as you will in an IUL through cash loans, okay? Through loans. The 529 plan is specifically for college. So you're not going to have liquidity because the focus is education. Let's see here. They have the IUL has guaranteed benefits. It has flexibility just to get as the high yield savings account. And then when we're looking at legacy and wealth transfer, the 529 and the IUL will have those components. Protection against inflation, because on average, inflation every year is about 2.91. These types of policies have been averaging anywhere between 6%, 8%, 10%. Okay. So they are able to outpace inflation because they're earning higher than what inflation grows. Okay. So strong vehicles for that. A high yield savings account, typically a CD account, they'll only earn about 3%, maybe 3.25. They're really not outpacing inflation. And where this one really stands out, the IUL truly stands out, is that it doesn't affect financial aid because it's not viewed as an asset. You want to take over again?
Yeah, sorry. Thank you so much
No
for
problem.
that. But yeah, like I was saying, these are the features, right? When somebody is looking for something to save in and a type of vehicle to save in for yourself, for your children, you want to see is there growth potential, is there safety and protection, right? Tax advantages, liquidity, guaranteed benefits, right? The IUL is the only vehicle on here that can use the word guaranteed because it is tied into a life insurance policy and the companies are bound by contract, right, to offer the benefits that they say. So if we look here, it's just quickly looking, you can see, right, there are a few things checked off here, but for me, it was important to check off all the boxes. And thankfully, I had some family members who were in this industry who came to visit my baby, but lucky me, they came and brought me some peace of mind and educated me on the $1 million baby plan. And I was able to start something like this for my children and know that I'm checking off all the boxes. And I was able to have that peace of mind as a mother that at least financially, I was doing okay, right? Very overwhelming when if anybody is a mom here, when you first become a parent, you have a
Yeah.
whole life that you're in charge of now, right? A whole human is solely relying on you. So financially, I felt that security, that peace of mind, and that safety. So that is what we love sharing with parents, grandparents, and guardians, right? But if we look at the benefits to sum it all up, the benefits of this $1 million baby plan is the tax advantage growth that we've talked about, right? You have cash value growth without the immediate taxation, market protection, so you don't have to worry about losing a penny when the rest of the world is losing and the market crashes. The legacy and death benefit that Miss Gabriella talked about, being able to leave something behind for your family, right? Changing your family legacy by providing that financial security for future generations, flexible access to your funds. So you can do loans that can be taken tax-free for major life events or expenses. And then my favorite part that we don't talk about as much on here is that your contributions will come back to you one way or another, right? If we think about car insurance, for example, okay, we're paying a few $100s a month for car insurance. It's the law. You have to pay car insurance. But if you're a great driver, then you paid that $200 a month all your life, and that's it. Just to have that, I guess, that security or peace of mind that in case something happens, right? But you're not going to get that money back because you're a good driver. Here with this, whatever money is put in here is going to come back to you or your family one way or another. So whether that's the cash value and you use that cash value for, again, those life expenses or events, living benefits, which we'll touch on a little bit. So if your child were to get sick and you need to access this plan for living benefits, terminal illness, chronic, critical, it's available there. And then, God forbid, if something happens, a death benefit is there. So that money will still go again to the family tax free. So this is a, what do they call this? Like a Swiss Army knife type of a product, right? It's going to help your family one way or another, regardless of what life throws at you. So hopefully by now you're thinking, how do I set up $1 million baby plan for my child, right? The process is very simple. Number one, you're going to want to choose a reputable insurance company. So we can definitely help you there. We have companies on our platform that have been around for over 100 years, right? We heard about one that was 150 something years already, another one 170 plus years. So they have been around through depression, pandemic, different presidents, crashes, all the things, and have continued to insure their clients and promise to never lose a penny, right? So we have definitely reputable insurance companies to work with, but you also want to make sure that the company not only has a strong financial rating, but also has favorable IUL products for children because all IULs are not the same. So when I first started back in 2014, when I first heard about this plan, there were no living benefits available for children. So once I heard about a plan that now has living benefits for juveniles, for children, I got another one for my kids because I saw the importance in the living benefit. So you want to make sure that the company also has favorable IUL products for children. Next is structuring the plan properly. So this plan, a parent, guardian, or guardian will be the owner of the policy. The child is going to be the insured. And then you can choose the coverage and funding strategy that maximizes long-term cash value growth and also aligns with your goals. And the way that you're going to do that is sitting with a financial professional like Gabriella and myself or whoever invited you to this call. And we do what's called a financial needs analysis and really take a look at your whole financial picture and see what is the best route for us to go when it comes to structuring this plan for you based on your goals and your goals for your children. And then we also want to make sure that you understand this policy. So the education part is very important because we want to make sure you understand what you have So you understand why it's important to keep it long term, right? So understanding the growth and the protection features, the market index growth, as Miss Gabriella went into detail about, downside protection, right? Understanding that you have that 0% floor, so you don't have to worry about losing money when the market crashes. Tax advantages when you're able to access that money through loans or withdrawals, and then the optional riders for future insurability and long-term care. So those are those living benefits I was talking about that are available with children and understanding how those work. Once all of that is in place, then we can apply and fund the policy, right? So for children, it is minimal underwriting because life insurance is based on your age and your health, right? So this is why we are so passionate about sharing this for people to start young because the underwriting is very minimal. The cost is much less. The cost of insurance is much less. And then you want to begin funding early to maximize that compounding growth. And then once your child is old enough and once you feel they are responsible enough, it doesn't happen automatically, but you can transfer that ownership to the child in adulthood so they can start taking over the plan and contributing into the plan themselves as well. Right? So as the scripture says, train a child in the way he should go, even when he is old, he will not depart from it. So we are not just starting these plans for our children. We want to make sure they also understand the importance of it. So not only can they carry it on into their adulthood, but for generations to come. Okay. So we're going to go into the good stuff. We're going to share some real illustrations here to really uh, highlight the benefits and really show you how these work, right? And I'm going to refer to them. You might have heard it on different plans, but we're going to, I'm sorry, calls, but we're going to refer to these two as Mr. Start Early and Mr. Start Late, okay? So this policy here is actually for one of our business partners, her son, King David. And we're going to call him Mr. Start Early, okay? But if we take a look here, the parents are going to start contributing $100 per month into this plan. And because they start contributing money into this plan, if God forbid he dies tomorrow, there is going to be a $186,386 death benefit available to the family. So this family will not have to do a GoFundMe or borrow money to take care of services for their child, right? And of course, we are not doing these because we want to benefit financially on our children, but anything can happen at any point. Our business partner, Kimberly, whose son this is, unfortunately lost her youngest son. So it is very real. Anything can happen at any age, and we just have to be prepared. Okay. But let's look at this. What if he lives a long, healthy life and he needs some money down the road? This is where we see why this plan is called a $1 million baby plan, right? At age 69, because King David's parents chose to put $100 in a policy like this, by age 69, King David will have $1,956,365 in his cash value. Okay. If you guys are taking notes, I would like you to write that number down and we'll refer back to it a little bit later. I will write it as well. But again, if he doesn't need it, this is not King David's first policy. His parents also started a policy for him prior to this, right? So what if he doesn't need the money and he just continues to let it grow? By 74, it's 2.7 million, 79, 3.7. By 84, age 84, $5 million. So this is what Gabriella was saying. What if he doesn't need this? He passes away and leaves this to the next generation. How amazing is that for his children and his grandchildren to have that money left behind to them so they can make wiser choices, right? They can actually do what they love. And then if he becomes ill, so those living benefits, a lot of people don't think about illness when planning for their financial future. But again, Kimberly works in senior protective services and she tells us all the time she sees seniors that have to deplete their savings. They have to deplete their retirement funds. They have to even sometimes sell their home so that they deplete their assets just so that they can rely on government assistance to help them because they did not properly prepare for an event of if they become sick or have a chronic illness, critical illness, and so forth. So in this plan, if God forbid something like that happened, chronic illness, if he loses two of his activities of daily living, he's not able to maybe bathe himself. He's not able to transfer in and out of bed. He needs assistance for that. 30,000 per month would be available to him so that he can take care of those, expenses. Here in California, I'm in Southern California, to go into an assisted living facility in a shared room, mind you, is eight to $10,000, right? A new benefit on here is Alzheimer's disease. Alzheimer's is something that is quickly on the rise. We see statistically it's going to double within the next 5 years. But something that really shocked me when I looked into it, because I'm like, why is this a living benefit that we are offering? And it actually says that Alzheimer's is the seventh leading cause of death in America. I didn't know that. And the cost for somebody who has Alzheimer's to care for them, the average cost is almost $400,000 to care for that person, right? So being able to have 1.5 million lump sum access is huge here, right? And again, we have one of our clients had to put her mother in a memory care facility, and that was almost $20,000 per month, almost $20,000 per month. So this 1.5 million would make a huge difference for that family, right? Mentally, and so much more if they had these finances available to them. Okay, so Mr. Start Early, we're going to talk about um, young King David here. So his parents are going to put $100 a month for the first 5 years, and they are growing their business or growing in their career. So after that, they're going to increase it to $200 a month, putting 2,400 a year. And then once King David is old enough, once he is an adult, they're going to teach him how to properly save and where to properly save his money, right? So they're going to say, son, we've been putting 200 a month into this account, and we want you now that you're working to match what we're contributing. So King David's going to put 200, his parents will still continue to put 200. So they're putting 4,800 a year. And then they're going to stop paying into this at age 45. So these plans are very flexible as far as how long you pay into them, how much. As you see, you can increase over time. You can even stop payments if needed, if there's cash value in here. But let's look at this here, right? At age 45, they stop contributing altogether. They've contributed a total of 147,600 into this plan. But if we look over here in the accumulated value, there's $412,000 in his accumulated cash value. If you remember in the first slide that Gabriella shared, the average 401k account is only 240,000, right? So he's already doing better than the average American, which is what we are hoping for our children, right? By age 49, his cash value is 533,000. And then if God forbid he passed away, $1 million would be left to his family, right? Because this is called an increasing death benefit. So as his cash value grows, that death benefit amount also grows. And again, all of this is tax free. By age 60, his cash value has grown to $1 million, right? We saw that on the first page, and it will just continue to grow over time if he just lets it compound in there. But imagine, right, at age 60, even if we go back in his 40s, he needs to put a down payment on a house. There's $500,000 in here that he can use of his own money, right? So this is what it needs to be your own bank. He doesn't have to worry about a lender approving him or, will his credit score allow for it? Okay. So we are setting up our children to take control of their future, right? Not just have the money, but also have control over their future. So Again, like I said, you don't have to be a baby. You don't have to be a young child to start a plan like this. So this next person here, we're gonna call him Mr. Start Late, but he's still doing pretty good. He's only 23. He's starting pretty early, right? So he's starting his career. His parents didn't know about this. They weren't able to start something like this for him when he was younger. But now that he's starting his career at age 23, he said, okay, I need to do something, right? So we sit down and he talked a lot about Social Security, right? So I looked into some statistics for Social Security. As we saw, the average is about 1,976, but I wanted to know, what is the maximum somebody can actually get from Social Security, okay? So based on what I learned in 2026, the maximum somebody can get is $5,181 per month. But in order for them to get that, they need to work 35 years. They need to make $184,000 per year, and they have to wait until age 70 before they can claim it, right? So even if we just go back to having to make 184,000 per year, you need to make 184,000, the maximum taxable income for that year, just so that you can retire with a little over $60,000 per year, right? $100,000 plus cut in income, change in lifestyle, right? So I showed him those numbers, and then we kind of did an apples to apples, right? If you work 35 years, you contribute into here for that long, you wait until age 70, what will that look like for you? Again, he's going to start with 150 per month, and we're going to slowly increase over time. If God forbid he dies too soon, 167,000 will go to his family. If he needs cash, so a little bit different than King David, we turned on here what's called lifetime income benefit rider. So if this young man needs cash at age 70, he could collect 6,579 per month for the rest of his life. And this will be tax free, right? That Social Security still needs to be taxed. So he was like, okay, this looks good. And he doesn't have to make 180,000 to qualify for this, right? He can make 80,000, 100,000, whatever career, as long as he's contributing into this account. Again, all of those living benefits are still available to him. If something were to happen, terminal illness, he'll have 1.1 million at age 70. Chronic illness, 22,000 per month to help with his care. Critical illness, almost $1 million lump sum. Critical injury, the same, and then Alzheimer's a little over $1 million. So pretty similar benefits to King David, Mr. Start Early, right? But we'll see how this changes over time. So we have this young man here. So he's putting 150 per month the first 3 years. He's expecting to get a raise in his career, increase in income. So he's going to increase that to 250 the next 3 years, 350 the following years, 450, and then he's going to level out at contributing about 500 per month for the duration of the time that he's contributing, right? So if we see here, very similar to King David, this young man is going to stop contributing after 35 years. At age 57, he would have put $181,200 in here, okay? Again, very similar. He has 500,000 in his cash value at that point. So again, doing way better than the average, double than the average 401k account at this point. But let's look here down below, right? At age 70, he decides, I'm going to use this as my pension-like income, my lifetime income. He's going to be able to collect 78,948,000 per year for the rest of his life. Okay. But did anybody write down the number of how much cash value King David will have at age 69?
Yeah. Was it 1,956,365?
Yeah, so 1,956,000. So their plans look pretty similar, right? They both perform pretty well. But when we talk about how valuable time is, right? For King David, they contributed, I believe, it was about 147,000, had 400 and something thousand in the account by then. But if we look at age 69, right? That was age 69. King David had 1,956 to
1 million.
65. Yeah, is that right?
Yeah.
Okay.
Oh,
So let's look
365.
at
That's okay.
close. Okay. So let's
Yeah.
look here at age 69, still doing really well, right? But Mr. Start Late only has 1,000, I'm sorry, 1,096,507. Okay. That's $859,758 difference. Okay. So imagine what King David's lifetime income is going to look like. Almost double that. He can be in six figures in lifetime income because his parents set up a plan like this for him and chose to put their money in a vehicle like this instead of a savings account or under their mattress, right? So that's what we mean that time is more important than money sometimes when it comes to saving for the future. So we see here Mr. Start Late, just in the first 3 years, he's recaptured all of this 181,000 and some just in his first 3 years of lifetime income, right? He already would have collected 236,844. But I always say, he's not going to have financial stress, so he's probably going to live a very long and healthy life. These policies cover you all the way age to all the way to age 120. So if this young man makes it to 120 because he has no financial stress, he's healthy, he's living the life, he could collect $4 million from this plan in lifetime income. He has no worry of outliving his money, right? Plus, if when he passes away at 120, there's still 88,687 left behind. So his family won't have to do a GoFundMe to take care of his final expenses and things like that, right? So a very powerful plan, very important to start as early as possible so that we can also leverage time, right? How much you put in is important, but the time is just as important, which is why we love sharing this to parents and grandparents to start for their children. Okay. So again, why start early? There's lower monthly premiums, lower total contributions, more years for compounding growth, greater long-term cash accumulation, future financial flexibility, and lifelong insurability. So what that means is if you put a plan like this in place for your child early, and somewhere later down the road, they have an illness or something that would ultimately make them uninsurable, this plan is already locked in for them, right? They already have this coverage locked in for a lifetime as long as you continue to fund it properly. All right. So again, we've said it several times here, but time matters more than money, and starting early makes a very huge difference. So we have been together for about 45 minutes tonight, but I hope you guys gained some very valuable information. Your next steps would be, if you're invited to this call, to get back to the person that invited you, set up an appointment to structure a plan for your children or even for yourself if you don't have something in place for yourself. And let us help you create $1 million babies, whether they're 5 years old or they're 45 years old, right? Refer you, if somebody came to mind as you were listening, refer that person either to the person that invited you or to our call next week. We do this every Wednesday, 6:30 Pacific, 8:30 Central, 9:30 Eastern. And let's make $1 million babies. So I want to thank you guys so much for joining us tonight. Thank you, Miss Gabriella, for co-hosting with me.
You are
And
welcome. The pleasure.
yes, we hope you guys had gained some great information, and we look forward to seeing you on the next calls. Thank you,
Good night,
everybody.
Thank
everyone.
you. Bye.
Bye.
Bye.